Equity markets tank as Trump's Liberation Day tariffs exceed all bad expectations. Bitcoin holds in relatively well despite hitting new lows, having slipped sub 80K. Meanwhile, as equity volatility explodes, Bitcoin vol remains relatively unfazed, leading us to question, have we reached new levels of maturity for Bitcoin? All this and more on this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everybody. I'm David Brickell from FRNT Financial, and my usual co-host, Imran, is not with me today. He's taking a short break. However, I'm delighted to be joined all the way from Chicago by a friend and frequent guest of the show, Head Director of Derivatives at Amber Data, Greg Magadini.
Thank you so much. Happy to be here again.
Yeah, great to have you on. And what a time to have you on, Greg.
Yeah, fantastic time. Markets are going crazy. Your guys' studio looks great.
Yeah,
it's nice to be out here. Actually came out for the Deribit event, the bull run. I have this t-shirt here. Quite the event. Very excited about that.
Yeah.
And then doing a little back-to-back with the podcast is very nice.
Oh, good stuff. I mean, where do we even start with markets and what's gone on? We were in the studio last week, and we had Bernardi Biswal on from Hilbert Group, and we were talking about how we felt a lot of bad news was already priced in and into this market, and we were a little bit sanguine around what we might get from Liberation Day, and yet bang, it was more than I think anyone had thought. What's your initial sort of take on what's gone on over the last week?
Yeah, I think initially my initial take is the market was, clearly caught off guard. Their positioning, I would say, maybe a little bit complacent. So just kind of off the top of my head, we had VIX open at 60 yesterday. We've only really seen that during COVID, this August 5th kind of meltdown with the Japanese yen, and then the great financial crisis. So, is the announcement of tariffs really as scary as COVID? In my mind, not really. But I don't think the fundamentals are the only thing that play here. I think it's also positioning. So we had a really interesting 5% day down on Thursday, 5%, I'm talking about the equity space, 5% day down on Friday, closing at the lows. The overnight futures open was like the most predictable thing you could think of. Of course, you're going to gap down, trade up, market open, trade down again as people like reshuffle their positioning because everyone's jammed into positions. These types of environments are really, I think, the most interesting environments to play. There's a long vol opportunity and a short vol opportunity. I tend to play the short vol opportunity because I think it's a little bit easier to react to the event as opposed to predict the event. If you wanted to do the long vol opportunity, all you would essentially do is, buy a straddle right in front of the Liberation Day announcement and hope something happens. The payout profile of that is that you're going to lose a lot. Yeah. And once in a while, you'll make, 100x. The inverse, which is kind of the way that I tend to play these markets, is, don't get jammed is the rule number one. But if you're flat, which I was, this is one of the greatest times to make, you make your whole year and then you can take the rest of the year off, so to speak, because the event happened and short vol is mean reverting. So you can actually, where the terminal value is, VIX is going to come back down. You don't know the path. And so if you can manage that risk and manage the path, that's really how you make money. So anyways, long story short, I think positioning was the reason. I do think things kind of revert and calm down in the medium term.
Yeah.
But yeah, that's kind of it.
Yeah, I was taken a little bit by surprise, given that throughout Q1 we had quite a big sort of grossing down of risk because of all the uncertainty leading into this. So I felt risk positioning was reasonably light, like coming into this generally, and I still think that's possibly like quite true. I think certainly hedge funds have grossed down a lot, and they've obviously grossed down more. So when I kind of think about how this plays out, obviously we saw some sharp moves Thursday, Friday, and then obviously yesterday, which then we kind of bounced back from and settled down a bit. So I'm still of the view that we've probably seen a lot of risk gross down. Now, obviously, uncertainties like at max, max uncertain right now. So it's difficult to see at what point people start putting on risk. And obviously, the path from here is that do we get an escalation of like retaliatory sort of measures, or do we move to some sort of compromise? And we've kind of seen bits of both, right? In terms of response. The probably only one that matters is China, and I want to speak a little bit about that. But look, what we've seen is markets have quickly gone to price essentially global recession risks, which have really stepped up a gear, as this is obviously impacting everyone with what the US are doing. So we've quickly sort of gone to reprice that. We've seen a massive grossing down of risk. And then, as you say, it all becomes about positioning. Again, when you get a VAR shock to the levels we've had, and you're talking, as you say, kind of COVID and global financial crisis type level shocks in some of these markets, then everyone just has to take down risk. I mean, you even saw as well gold actually starting to get hit. Tail end of last week, which I imagine is making margin calls. So it's kind of peak uncertainty. Let's all take down risk. And I think we've probably seen a lot of that going on. Now, there will still be like the momentum CTA type models that are now, mechanically going to be selling because that's what the model's going to tell them as moving averages, crossover and all that stuff. So again, very much almost like a similar COVID type playbook where it's hard to know where that process of de-risking ends and where those CTA momentum type flows, when you start getting the other side to it, that can actually offset it and support the markets. But that's kind of where we're at right now. Interesting that you say, and I agree with you, like it just feels a bit overdone to me in the sense of this isn't COVID era bad. Obviously huge uncertainty, we get that. But I think one of the interesting things is there's also been so China's like the big thing for me, and I don't know how you feel and if you've got thoughts around this, but that's the big sort of elephant in the room in terms of who we need to come to the table, and they're obviously the ones right now pushing back the most in terms of like the retaliating with counter tariffs and whatnot. There's been a lot of talk that we interestingly saw. I mean, the bond volatility has been like off the charts, right? Which again is not great for liquidity, and that kind of weighs on crypto, Bitcoin, what have you. But there's been a lot of talk that are China now selling treasuries, and is that why sort of yields are going higher? Again, my kind of thoughts on that are that actually they're probably not yet. I mean, they could do, but I don't think they are. I don't think it would make sense for them to do that just yet. But I think the reason we had that treasury sell-off yesterday was probably, again, treasuries being sold to make margin calls. So there's a lot of noise and a lot of conspiracy theories and that knocking about, which is usual and to be expected in these markets. The other thing as well, China did this morning weaken the fix past this sort of 720, which was a line in the sand. So now obviously we get growing expectations that they're going to sort of devalue the currency. Again, I'm not completely on board with that in terms of China at the moment. I think want to be seen as like the stable one in this kind of global regime. So it wouldn't make sense to me that they completely let the currency go. But maybe they're just trying to give Trump a little reminder, like, look, if we do this, A, we can offset the tariff impact by devaluing the currency. B, it'll cause more stock market upheaval and it'll tank your stocks even more. So there's a huge amount going on. Again, we probably settled down, I think, because of de-risking settled down. The interesting thing is crypto, and I think let's bring it back to that and thinking about that. Bitcoin actually last week didn't really go anywhere, which was amazing. And then everyone was talking about this, decorrelation and what have you. I do think, and I know we spoke before and perhaps have maybe some slightly different views. I've always said that I feel like Bitcoin captures both like the far left and far right of the tower of the risk distribution. And there were signs of that last week, maybe, that in the big blow up scenario where we're questioning sort of, the sort of global economic and political structures, then Bitcoin as like a non-sovereign, borderless
Of course.
currency is kind of the ultimate hedge alongside gold. Um, and there were thoughts that maybe we were starting to see that as that kind of safe haven aspect. However, then obviously the weekend, we're trying to, we had no climb down from Trump. Markets tried to pre-position ahead of like what we knew was going to be a weak open, equity open. Bitcoin gets hit below 80K, and then we make new lows, and then it kind of feels like we're back to trade and risk. But it's certainly been impressive that it's that we've held in so well in Bitcoin,
Mm.
which again kind of for me feeds my long-term kind of bullish view on how it matures. But I want to get to you on the vols and what's been going on there, because really interestingly, given that we've had an explosion in vol in the VIX and in equity volatility, we've had an explosion in bond volatility. Bitcoin vols particularly have been pretty muted
Yeah.
given what's going on. So yeah, I'd love to get your thoughts on what's going on there, and just as well for our viewers, just to describe what the vol environment and what's been going on in crypto vols.
Yeah, absolutely. So just kind of briefly speaking, if we look at the DVOL index, the Deribit VIX of Bitcoin, so to speak, that's around 55. During sort of the FTX bankruptcy, Three Arrows Capital, COVID, we saw it in the 160 area. So, 3 times where we are today. Given where the other vol complexes are, including gold, including bonds, including equities, including VVOL, VIX of VIX, all at 99th percentile, it's kind of interesting to see crypto not move the same way. Everyone knows in panic correlation goes to 1. I think that's also true across asset classes in terms of vol. You're not going to have volatility in 90% of your portfolio and like no volatility in this one little sector of a high risk asset. And by high risk, I just mean historically moves around a lot. So theoretically, correlations go to 1 both in vol and price terms. I think what's happened a little bit is that I do think, to your point about de-risking, I think crypto kind of led the way lower. We had a lot of positive headlines, and since the inauguration, kind of just sold off despite headlines. We had the U.S. Strategic Reserve announcement, which was a one-day rally that's instantly slammed back down the next day. Not very bullish in my mind. So I think there's a little bit of that, maybe seller exhaustion in that market. But to your point about the right tail and the left tail risk, I think the left tail risk is pretty clear, right? Everyone wonders, can crypto go to zero? Yeah, maybe. I don't know. Like, anything is possible. But there's also the right tail risk of Bank of Japan buys Bitcoin for its balance sheet. Other countries do the same thing. Or if trade frictions become so unstable that the US dollar either threaten the reserve currency or bond market sort of panic that hurts the US dollar, or people want a sort of Switzerland of currency to settle international trade and they go towards Bitcoin. Again, anything is possible. That's a $10 million Bitcoin scenario, whatever it is. So to your point, I definitely think the tails are pretty interesting. Um, I do think there's probably some ball structures to be made around both tails. Um, and as of right now, the current vol environment being so low doesn't necessarily mean go out and buy vol, because things can just sit here. But I'd be very weary. I would say I'm not interested being long here. I'd rather buy on the way up, or I do think there's probably some testing of the election levels for Bitcoin.
Yeah, and so when we broke below 80K, right, in the very front end, like put skew went
Yeah.
like super bid for puts. A little bit further out, what, 1 month and out, again, not a huge amount of skew. So
Yep.
still no signs of kind of like panic or
Right.
like complete bearishness in the view, sort of a little bit further out. Is that fair to say?
Yep, I think that's fair to say. I think that's really an interesting opportunity in my mind. Like the market, I mean, right now vol's coming back, so not a great time to own vol right now, more of a short vol environment. But if vol's going to come in when the markets crash, which is basically what we've seen in all the asset classes right now in this environment, um, owning the put skew is, or owning the puts against the calls is what's more interesting. So, buy Bitcoin, buy the put, sell the call, do some sort of structure like that. It's an interesting risk reward, I think.
Yeah. What about? Again, I guess what makes all of this really difficult is it still feels. I mean, we saw yesterday, right? We got a headline out saying that there were some agreements for a 90-day pause on tariffs and everything.
Right,
Turns out it was it was fake news.
right.
And then we come back, but it does feel like there's growing pressure on Trump from. I mean, talk that Elon Musk has kind of told him to step back from tariffs. Besson is kind of trying to push the let's make deals. I guess what makes this environment really difficult, like to trade, is we could be a headline away from a pause or some big deal. Particularly, I think China's like the big one. If we get some sort of agreement with China, then that's really like risk is off to the
Yes,
races, and this
100%.
whole market gets thrown the
Yep.
other way. Bitcoin still has this kind of like positive spot vol correlation, I guess. Like how would you be thinking about that given those risks that we could all just rip? Like,
Yeah, 100%. I mean, I think that's a great point. You could definitely see the Bitcoin positive spot vol correlation 100%. You'd have to hedge that out somehow, um, sell a call spread and own the underlying. That way you don't get totally
yeah.
hosed. But agreed, the tails can be pretty interesting both ways.
Yeah. So, I mean, Greg, you're a trader, right? This is your environment, right? This is, this is what you guys live for. I'm sure if Imran was here, he's taken a break at possibly the worst time in terms of him would love sort of trading around a lot of this stuff. So talk to me about how you look at trading these environments, and the strategies that you use, and how you just look at these markets and how you think about them.
Yeah, absolutely. I mean, I would love to chat about that. I think, taking a trader's perspective to these types of markets, there's always unknowns, and you can't, in my mind, like it's almost impossible to know what's going to happen. It's just a lot makes more sense to react to things that might have overreacted in sort of
Yeah.
my type of thinking. But people trade things a lot of different ways. And I think, people who are trading crypto or trading volatility on Deribit, just kind of different styles that fit different personalities. The main two initial styles are trend following versus mean reversion. One of the nice properties about trading volatility is that it's a mean reverting asset class. And so the game is you essentially know with a high confidence interval, where's this volatility going back to? And you have a pretty good guesstimate about the timing. What you don't know is the path. So things can get a lot worse before they come back in. And so your job is to essentially manage the risk along the path of the journey to get to that destination. And that's how you make money. And you don't want to take too much risk off the table, or else you don't make any money. So that's a little bit of the game. The other part of the mean reversion game is that the obvious trade typically has negative carry to it. And so you got to calculate that into your sort of your timing of the trade and all that stuff. The trend following games is really different. That one is a little bit more of a prediction game. Getting on early in the trend, for example, owning Bitcoin at 30 cents. That's the perfect trend play.
Yeah.
That game's not easy either. There's still a different sort of risk profile that you got to deal with. Let's say you invested $1,000 in Bitcoin at 30 cents and now it's at $30. Like, what do you do with that? Well, do you size down? Do you take money off the table? Because the problem with trends is like eventually they break, or there's a big correction, and you lose a lot of the money that you made along the way. But if you get off too early, you might have, a really strong trend can last years and years and years, as we've seen in Bitcoin from 2008 to today. Um, if you get off too early, it might be the only good trade in your entire lifetime. So I think that's a little bit of the different balancing game. So a lot of people have to like see what fits their personality. I know for me, um, mean reversion makes a lot more sense because I'm a quick in, quick out type of trader. A trend follower is more like hold and like, hodl across all the peaks and valleys. That is definitely not my personality. So
Yeah.
yeah,
Yeah,
that's
which
how
it's interesting
categorize
because
it.
that's often like Vimran and I. That's where we differ, right? He's a trader, and I mean, he has core long-term views, and like certainly when it comes to Bitcoin, and he'll have those kind of core sort of cash holds, and then he trades around it, and he'll trade the volatility around it, and he'll trade a lot of these mean reversion type strategies. I'm not half as sophisticated, so I'm a lot more. I'll allocate according to a kind of macro thesis, and my timeframes tend to be longer term, like anything from 12 months to a few years, as I try and capture those sort of bigger trends.
Hmm. Hmm.
Although increasingly I'm thinking I should be hedging myself around around some of these moves. And what one of the trades that Imran's been talking about for a while is, like uh, just the risk reversals, as ways of, because I mean it probably looks different now, but because we still had this skew, further out for calls, favoring calls to actually kind of sell and give up some upside, but you're still able to lock in a lot of upside for say 6 months to a year,
Right.
but to protect yourself on the downside and then monetize some of that to give
Yep.
yourself cash to buy the dip, right? Well, would love to know what trades you're looking at right now, especially given this uncertain environment. Are there any kind of clear trades for you that you've got on or would like to put on? And what's the opportunity set that you're looking at that you think makes sense for me or anyone else to be looking at?
Yeah, I think that's a great question. And I think the way I like to think about it is there's scenarios that I want to be aware of. So we talked about the positive spot vol correlation and the option skew a little moment ago. I think one of the big things that we're going to see in crypto vol is a structural change in terms of having IBIT being about 40% of the volume that Deribit does. That's a pretty successful product launch. And now we have a class of investors that have deeper pockets to sell volatility. And so in my mind, that's a catalyst for a structural decline in volatility. And then you have the traditional institutional flow, like you say, with Imran's position, you buy Bitcoin and you sell the covered call for a yield. And sometimes those institutions also buy the put. That's the typical equity flow from, pension funds and things like that. That smashes that risk reversal. It flattens the call and makes the put more expensive. I think structurally we'll get some of that. Cyclically, it can, if retail all buys vol at once, it doesn't matter how many institutions are on the other side. It's going to be overwhelmed by the retail flow. And we've had strong moments where crypto is, very, very FOMO markets, and when vol goes crazy and you get those types of interesting callers you can do for interesting payouts. So that's a scenario I want to keep in mind. I think there's a couple macro scenarios that I'm trying to keep in mind. I remember historically in my career, there's a few things that were like really big moments. Obviously, during COVID, oil going negative.
Mm.
That's one of those that will never happen type of trades, but it happens. Interest rates on bonds going negative. That will never happen type of trades. That happens. Um, and then for anyone who's trading vol or is trading future spreads, I remember when I was trading Treasury basis spreads in Chicago on a prop desk. One night we just had someone fat finger 30-year bond futures, and you're trading a pretty tight position with low risk, but it's a three-legged spread. And if one of the legs just blows out because someone fat fingered the market and traded through 30 levels on the order book, all your spreads blow out. And the thing about spreads is you have them on for size because
Mm.
typically they're pretty tight. So there's always that type of crazy tail risk. And I think in this environment, we have that tail risk. You brought up the tails for Bitcoin, upside and downside. I think that's totally true. I do think an interesting tail is the US Treasury market, the long bond. I think if trade wars go wrong, I do think there could be a sort of a strike from the international community. While we are financiers of your deficits, United States, and we want to stop buying your treasuries. I think that's a scenario. I still think the JGB, Japanese yen scenario, and the Japanese the country of Japan is the biggest owner of U.S. treasuries. It's always neck and neck with China, but it's very close. If there's any sort of crisis there, does that affect U.S. treasuries? So I mean, vol's high in bonds right now, but I think the weakness that we've been seeing in bonds is kind of interesting. We've had like this, SPX went down 22% in 7 weeks. and bonds instantly gave up the whole rally that they did in one day, that is not that is not
Yeah.
bond bullish. And I like bonds, but I don't like that move. And so I think there's something to be
Yeah.
said
And
there.
I guess the interesting thing as well is like, Trump and Besant, like their whole thing has been around wanting to get like treasury yields
Yeah.
lower. And ironically, again, don't know if I necessarily subscribe to this theory, but the idea that they're willing to blow up the stock market in order to force the Fed's hand, cut rates, get yields lower to help them with this, what, $8 or $9 trillion of debt that they need to refinance this year, which obviously compared to where that would have originally been financed, we're a couple of percent higher in yield, and obviously that debt dynamic
Right.
is becoming very problematic. So it'd be ironic if, after all of this, if that was the if that was the goal to essentially let's get yields down first, roll the debt, and then we can sort out the stock market after. That's potentially going to backfire. I think one thing I mean, first it's worrying that, and I kind of feel a little bit smug, to all my TradFi friends who, want to say things about Bitcoin and the volatility, and it's like this is like the deepest market in the world in
Right.
treasuries, the benchmark of everything,
Mm.
and it's swinging around like this. It almost feels like Bitcoin has gained at least a little bit of credibility over the last
Mm.
week or so. But yeah, we see how things settle down. I certainly think that like treasuries would have been getting sold to make margin calls. Are 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 China selling treasuries again? Like we alluded to earlier. I don't think so. And again, the reason I don't think so is because also in the last couple of days we saw the dollar go bid. Now, if China was selling treasuries in size, then they'd also need to be selling dollars, and we've kind of not seen that. So I think for now, I kind of lean on the view that maybe we just had a lot of treasuries getting sold to fund margin calls, and we'll see how things settle down. Either way, I don't think the Fed are going to like to see this level of volatility, and I still feel that they will come in and support this market, and I definitely feel they know their responsibility to support the treasury market. We've already had like the QT taper, right? Was because they're concerned around treasury market liquidity, as well as reserve levels in the banking system and whatnot, around this whole debt ceiling, and then when that gets removed and the TGA gets built, so they're very conscious of their need to essentially support that market, hence they tapered QT. Jay Powell's already spoken to Congress and said, look, we probably need to either reduce or completely eliminate the supplementary leverage ratio, which is the amount of capital that banks need to hold against their assets. And by removing that for treasuries, basically means it's going to encourage or incentivize banks to go and hold treasuries.
Mm.
So I think the Fed are very already aware of the need to support the treasury market. And this treasury volatility, it'll be interesting to see what comes out of the Fed over the coming weeks. Obviously, we've got a interest rate decision in May, just to see how they're thinking around that. I'm still very much of the view, and this is why I always kind of have a bullish lean to how I see markets. I still feel that central banks have kind of removed that left tail risk, ever since 2008, and in any moment, whether it be the regional banking crisis that we saw, when was that, 23?
Yeah, yeah. SVB banking
Yeah,
crisis.
yeah, when all that blew up, and the Fed are in the middle of a hike cycle, and yet they came in and
Yeah.
they injected a lot of liquidity to backstop that market. The UK gilt market, before that, when gilts were blowing up again in the midst of our own hiking cycle, the Bank of England come in and go and support that market.
Right.
So I think central banks are very, very aware of the need to support their local government markets. So I don't see it sort of being let go, but ultimately I think it brings me back into a world that we're going to see more financial repression and more liquidity, and that's kind of why I actually think a lot of this is leading into, like, again, just more of a bullish story long term for
Mm.
for Bitcoin. Short term, sure, we're going to trade this sort of volatility, and right now we're peak uncertainty, and anything could change by the time this gets released. something could have changed. Trump's come and climbed down a bit. But I think it all leads us into this world of sort of more liquidity. I also think, and we spoke about this before we came in the studio, what I do think is interesting is like the uncertainty, whatever happens from here, this uncertainty is certainly gonna have disrupted. Like, I mean, I think global growth was sort of struggling in a way. Certainly, obviously in China, they were in a deflationary spiral. Europe was kind of struggling. So I certainly think we're going to see a bit of a global slowdown on the back of this. And what that means for me is we're probably going to see major central banks, including the Fed, including the ECB, um, that I think we're going to have to see them cut deeper and further than what would have otherwise been the case. I think we're already starting to see China already said they're going to front load fiscal stimulus. So I think we're going to see like more stimulus, more liquidity supplied to these markets. So the interesting thing that I think this last week might have done for Bitcoin is I think we've probably extended that 4-year cycle that we're very used to,
Hmm.
because I think we're now extending the sort of central bank cycle, if you like, or the macro cycle, because I think now we're going to see this cycle, this cutting cycle, prolonged and go deeper than perhaps we would have done before all of this.
Hmm.
Which for me then says we get a longer Bitcoin cycle with potentially a higher peak. So if we want my bullish narrative, which people probably aren't surprised that I fall on, I think we potentially are actually laying the groundwork for us to actually not just see our usual kind of, as Raoul Powell likes to say, this banana zone move. I think we potentially see a higher peak in Bitcoin because this is going to force lower sort of global rates, and also it's going to force like a liquidity fiscal response to support a global economy that can't take a global recession right now. What are your thoughts around that?
Yeah, I mean that's interesting. I mean, I think the bullish right tail case definitely has a place. I think for me, I'm not interested at these levels yet, so to speak. In terms of crypto as a whole, I mean, Bitcoin white paper launches at the tail end of the great financial crisis, call it 2009-ish. And then the SPX has really rallied from 667 to 6100. It's almost 10x
Mm,
in the past, whatever, 16, 17 years. We haven't seen an environment, and let's just say again, I don't know if this is a true bear market. I mean, it's a technical bear market, the 20% mark for equities. Is it like a true bear market, global recession? And if so, how does crypto perform in that environment where both asset classes are in a bearish environment? I just haven't seen it. But I have seen, I mean, in 2017, Ethereum rally from, $3 to $1,500 back down to $84 in 2018 while equities are still ripping higher. So I wouldn't underestimate the pullback potential for crypto. And I like the right tail trade. But I think there's going to be levels that are amazing to get in. And right now, to me, it's just not like a screaming buy. But again, like I might totally be wrong and I might end up just buying higher. And I'm cool with that. I'd rather buy the Bitcoin new all-time highs
yeah.
than here at 80K.
Yeah, I think what's interesting as well, like a big part of like the Q1 correction, like it's certainly in Bitcoin and more so in the alts. I think, and I've spoke about this before about, I mean, we had the kind of hawkish pivot from the Fed in December, but I kind of felt if I looked last year throughout the summer, we were actually on this like kind of softening like data path for the US. Again, I've not been in the recession camp, but I've almost been in this Goldilocks, slowing, not collapsing economy, disinflationary economy. Then we had this really strong Q4, which I think was the US living off of like the sugar high from the pre-election spending, which is obviously now fading, particularly as this current administration look to kind of cut spending and look to reduce deficits. But we had this huge run up in the dollar, huge run up in yields, like all in kind of Q4 in anticipation, and then the Trump trades as they were then, and that's like hugely tight financial conditions. we've now started to see that like unwind. So I think kind of Q1's been living off of that financial condition tightening. That's now unwound a lot. We've had a much weaker dollar throughout Q1. Yields have come substantially lower. So I kind of think as well, we've got these dynamics feeding in whereby actually financial conditions have eased quite a lot.
Mm.
Obviously, everything that's going on right now is that there's just high uncertainty. So, how much will that kind of positive liquidity environment, if you like, from a point of view of financial conditions, start to feed in? I'm not sure, but I think if things start to settle down, then I think it has the potential for to certainly in crypto to sort of rip everything higher. Um, but yeah, the other thing I still go back to, I think we're a function of rates and liquidity overall, and this is I have this conversation, particularly with a lot of macro guys who tend to lean on like the bearish side of markets, where they're almost looking for like this mean reversion in stocks after a one-way move for so long. But I'm kind of like, look, we're a function of rates and liquidity post 2008. That's kind of my thesis, and partly in these fiat debt-driven worlds, to grow, we need ever more debt, right?
Mm.
And to facilitate that debt expansion, we need asset prices like equities, which are the collateral which underpins the debt, to keep going ever higher. So I kind of feel like again we'll hit a point where the Fed or and central banks will be forced to support these asset markets and just inject like a shit ton of liquidity into this market, to kind of keep things supported. So I kind of take your view on that. We could see this correction given the move we've had. But I think that move has been partly, sponsored by and funded by the central banks, that have needed to continue to artificially inflate the asset markets. And I don't see how we've gotten away from that yet, which is why I'm not so bearish throughout this year. And I can see essentially if we do start to get the huge growth slowdown, even recession risks. Obviously, the knee jerk from risk markets is to going to trade lower, and Bitcoin won't be immune from that. But I still think we'll see the response of sort of great liquidity injections, lower rates, and that reflexively will stimulate markets again, and drive equities higher. But I think all of this still, for me, it all leads back to Bitcoin being it kind of almost, it's like checkmate. It's like
Right.
either risk is going to sort of pick up, and it's kind of going to just trade with that, or the world's a mess, and then central banks are forced to come in to support these markets, the debasement of currency and that whole story, and then we go back to that kind of right tail scenario for Bitcoin. So
Yeah, that's a good point. So I think one of the things to keep in mind is sort of the investor profiles. I think the trend of the dollar purchasing power or fiat purchasing power since, call it 1900s going down, don't fight that trend, but there's wiggles and waggles in between, and if you're trading, either you're trading options or you're trading futures on a levered basis, the long-term position is a little bit less important. If you're an investor and you have a 10-year, 20-year, 30-year, 50-year, own real estate your whole life type of deal until you're an old man or old woman, then who cares about the dips? If you're investing in your 401k for 50 years, don't time it at all. Like there's
yeah,
guaranteed dips and recessions within that profile, and you just dollar cost average and don't even worry about it. And I think that same sort of scenario for Bitcoin makes sense if you're dollar cost averaging for 30 years. I think if you're trading options and you're trading perps, um, that time frame is a mismatch.
yeah,
I think you need to pull back in a global recession before you get the central bank intervention or whatever it is. There's a lot of trading opportunity in that window. Talking about sort of
yeah,
back to the bonds real quick. Right now, 6-month bond put plays, bond price puts, yield calls, so to speak. $150 pays you 3,000 if bonds go to 6%. So that's a 20 to 1. But I mean, with Liz Truss and the UK gilts, I mean, they went from what 3% to 5% in a couple of months. That's a big move. There's a lot of money on the table to be
yeah.
made right there. And the fact that we've seen this happen in the UK, why couldn't we see it happen elsewhere? That's kind of my thinking there. But I agree with you. Long term, if you're just holding Bitcoin and you're just stacking Satoshis, so to say, Yeah, I mean that's a very very convincing argument you make.
Yeah, Greg, this conversation is fascinating. So much that we could continue to talk about. One obviously really important aspect in these volatile markets is collateral management, and I'm sure that's something you're very acutely aware of. So on that, I interestingly recently caught up with Guy Young, the founder of Ethena Labs, alongside Josh Lim, who's global co-head of markets at FalconX. I wanted to catch up with them to discuss, and I don't know if you saw this, but recently Deribit have added Ethena's USDE yield-bearing coin to their cross-collateral pool.
Yeah, that's great.
So yeah, so I just wanted to sort of catch up with them, find out what that's about, find out what Ethena are doing, and talk all things collateral. So take a listen to this and see what you think.
Hi guys, David here, and a special short segment to our show today. You may or may not have seen the recent announcements from Deribit, but they've announced Ethena's USDE coin for trading and cross-collateral purposes now available on Deribit. So we thought it'd be good to get the Ethena guys in, and the CEO and co-founder of Ethena, Guy, and also a regular friend of the show, Josh Lim, who you may know as a co-founder of Arbalos, now taken over by FalconX. But guys, welcome to the show. Guy, maybe best to start with you. To Ethena, tell us about it and your role there, and yeah, it'd be good just to learn a little bit about the mission behind Ethena, and exactly what you guys are doing there.
Yeah, for sure. And thank you for having me on. So yeah, a bit of my background. I started with Ethena around 2 years ago now, and we came out with the live product around 12 months ago, almost to the day. In that period of time, we grew from zero to just over $6 billion at the back end of last year, was sort of the peak of USDE supply. And that was one of the fastest growing dollar assets that we've ever seen in crypto. That's sort of like 6 billion over 12 months. The basic idea behind what we're doing actually came from an article that Arthur Hayes put out at the beginning of 2023. It was called Dust Uncrossed, if any of your listeners have come across it. And he basically just outlined why he thought this was one of the most interesting and largest opportunities within crypto, which was to create this idea of a synthetic dollar, which you can sort of think about as a tokenized cash and carry. I think the interesting quality of that was, the interesting piece, at least to Arthur in the beginning, was like this decentralized-ish component to it, which is like you're creating a dollar that exists outside of the banking system. But I think through time, actually, there are different qualities that people seem to be more interested in, which is actually the fact that you're tokenizing a funding rate within the asset itself. So I think the sort of like use and vision of what we're trying to do, I think slightly drifted through time, where in the beginning it was something that was trying to be a very different custodial risk profile to normal fiat stablecoins. And in the end, what the users liked was the fact that like funding rates are obviously quite excessive, and there's quite a bit of alpha, I think, in that market, which a lot of people didn't have access to. And your ability to basically tokenize what is one of the largest sources of like gross cash flow within the space into, one of the few products that has real product market fit, something that looks and feels like a stablecoin, was just a very useful collateral asset that you could sort of use throughout DeFi as collateral and CeFi, which you're obviously going to jump into. And then I think the last component of that is thinking about it as a product that you can actually ship from crypto into TradFi. So those are sort of the three buckets or components of how we think about the growth. And yeah, happy to jump into any of those elements you want to. Yeah.
Yeah, sure. And Josh,
yeah, it's been amazing to kind of see the growth that Guy and the team have been able to accomplish in a short period of time. It's like a testament, I think, to how much product market fit they've achieved within this asset class. I think it's sort of one of these things where, it has utility to a variety of market participants, right? Whether it's traders who want to use it as a collateral asset to put on other types of risk while sort of maintaining some exposure to, or doing it in a capital efficient way where you can continue to get yield on your capital. There's also some appeal to people who are looking just for market neutral yield, right? And then, even beyond all of that, just there's a cohort of retail users who use it for many purposes, including like being, DeFi native, being on-chain native, making being sort of independent of any sort of banking system and being able to operate, in a entirely decentralized way. That's been like a big appeal of Ethena as a crossover asset between, these sort of yields that exist in centralized marketplaces and people who want to live entirely on chain. So yeah, it's really exciting. Actually, it's one of these like thematic things that my firm is entirely focused on these days, is the idea of like C DeFi convergence, I guess is one way to put it. The idea that there's going to be more and more over time overlap between what exists on chain and off chain, and the people who benefit the most are those who can kind of like arbitrage, the relationships between those two worlds.
Yeah, interesting. And obviously we've seen, quite recently an explosion, I guess, of yield-bearing stable coins, some of which are actually on the Deribit platform. Guy, do you want to break down a little bit for those that don't know exactly how USDE is generating yield? And you mentioned obviously around the cash and carry sort of elements of this, just the collateral that backs it, and how that yield returns to the holders of USDE.
Yeah, for sure. So in most market conditions, we're essentially just using BTC, ETH, and SOL collateral, and then 1x shorts on the other side across both perpetuals and futures. That can change through market conditions, where if you get into periods where there's negative funding or exceptionally weak funding, which we've kind of seen in the last couple of weeks, we also have a separate product that sits on the side called USDE. So that looks and feels quite similar to some of the other, call it like T-bill backed yield-bearing stablecoins that you have on the platform at the moment. And the idea here is that you can sort of cycle between the two when, legacy rates are more attractive versus crypto rates. It's pretty easy to just reallocate the backing within USD between the two sources of yield. On like rough numbers, like the average APR that you saw from SUSD in the last year was 18% for like the average through 2024. And one of the interesting sort of designs within the token model is you have two tokens for USD. You have the plain USD, which you can think about as like the money that people are using to transact and trade, and that looks and feels like a normal stablecoin. And then you can stake that asset for SUSD, which is really where you're actually capturing all of the funding rates and staking yields that are being generated on ETH and Solana collateral. The interesting byproduct of that is that you tend to see that not everyone always stakes, and this is like the same for like proof of stake assets like layer ones, but then also even comparable assets like you see with MakerDAO with their DAI and SDAI model. And what that actually unlocks for you is either an opportunity to capture margin to yourself, i.e. like everyone who's not staking, you don't really have a liability to them to be able to pay out the yield on the other side, and that can technically be your margin to capture on like the Ethena side. So we did have periods, where we're capturing 50-60% of the entire rate back to Ethena in the beginning while we're scaling up. And then all the other thing that you can do with that is actually just amplify the yield so that you can sort of take from a portion of the people who are not staking and give it to the people who are, so that you're strictly better than the cash and carry in the market. And that's been a pretty powerful piece for us to scale, which is a lot of hedge funds, which are sort of just like doing it myself type of attitude. They would look at it in Ethena as like strictly better from like a returns basis because of that dynamic that I was describing within the two token model. And that's something that sort of you just benefit from the more that you can sort of proliferate the use of USD as money, whether it's sitting in order books and centralized exchanges, within AMMs on chain, lending within a money market. Those are all places where people will be using it productively and not staking it, which sort of allows you to do what I just described. So yeah, that's the sort of very basic dynamics of the yield. When you're using on a centralized exchange, it's actually almost a better version of SUSD because there's no unstaking period for using it there. And so we essentially have business-to-business relationships with each of the centralized exchanges where we just say, we're going to pay you a marketing expense and you can sort of decide how you distribute that to your users on the other side. And all of the centralized exchanges that we're integrated with now basically just like airdrop the implied return to their users on like a daily basis with no withdrawal queue. So you basically have daily liquidity and daily returns from just holding it, which we think is pretty compelling versus most of the stuff in the market. I think the most interesting piece of it, I would say, as it relates to Deribit, and it's something that Josh and I have gone back and forward on a couple of times, is actually the funding model in Deribit is actually quite different to different centralized exchanges. So they don't have this like concept of baseline funding where, it like averages out at 11% annualized. The funding in Deribit is actually quite a bit below market on average if you just look back through like even in the last year. So what that actually means is that when you're taking USDE and putting it on Deribit, you're actually importing higher funding rates from different exchanges onto Deribit, which you couldn't capture yourself. So if you think about a market maker who's sitting there on Deribit, to the extent that they were wanting to use a cash and carry position on Deribit to collateralize the rest of their option portfolio or whatever else they're trying to do over there, they'd actually be capturing a much higher yield doing that through USDE than trying to do it natively on Deribit because of that dynamic of no baseline funding. And that has like very interesting second order implications across the exchange, because if you think about even a very basic like 1x long on BTC, that's going to be a very likely like negative carry position most of the time, i.e. you're paying a very small single digit percentage to be long BTC directionally. You've actually transformed, if you're using USDE versus USDC, that's transformed from like a negative carry position to one that's like extremely positive basically in most market conditions. And that's actually a pretty powerful point, which is like you've completely unlocked a different form of like capital efficiency on the exchange.
Yeah, super interesting. And Josh, like from your point of view, from like a trading side of it, I mean, how important is this to you? I mean, I guess using yield-bearing stablecoins generally and the ability to use that as collateral versus coin-margined positions, you know, how impactful is that to your trading and your strategies, and how are you thinking about that?
Yeah, I mean, it obviously is it's more efficient from a capital usage perspective if you're able to sort of like combine collateral types, especially in underlying assets that are less actively traded, right? We all know Deribit's like starting to add more and more assets over time on the altcoin option side of things. It would be difficult, right, to kind of manage margin on each of those assets separately, and the cross margining model makes it a lot easier to sort of like put on positions that you would otherwise maybe have to otherwise source like collateral and maintain that collateral separately for. USDE is particularly useful for collateral on Deribit because you might already be using it as collateral on a number of other exchanges. So it's fairly easy. Like if you're putting on trades between exchanges, you can sort of move it around seamlessly. I think to Guy's point, it's really interesting to think about USDE as this sort of way to import positions that exist on one exchange to another, and more importantly, to import risk that lives on centralized exchanges to DeFi, because that is a very difficult problem that many, sort of these decentralized prime brokerage, on-chain prime brokerage type products have tried to do over time. And what I think, in my mind, USDE is like a sort of a distillation of that idea of just let's kind of figure out like the most basic type of position that you could have, which is this sort of basis position, and has some utility to it because it has some idea of like yield embedded into it. And if you're able to import that, then you can sort of go on and construct other things. Like obviously, if you're thinking a couple steps ahead, like you want other types of strategies embedded in these sort of tokenized formats, nonlinear strategies, vol strategies, things like that. That's like something that is probably further down the line. But in my mind, that just is kind of where this whole thing is going, right? Is just taking ideas or taking strategies that are easily expressed and should be systematized, and sort of putting them in wrappers that can be used in other formats and venues, and crossing that chasm between like CeFi and DeFi.
Yeah, for sure. Hey, Guy, what do you say? We've mentioned like that there's other kind of yield bearing stable coins out there. Like, what do you see as like the kind of really unique elements around Ethena and USDE that you think really sort of separates you from the other guys?
Yeah, it's difficult to actually be unique, I think, because even just stablecoins as a category, there's only like 3 axes you can actually think about kind of competing, and this is kind of why Tether is so successful, is that it's actually difficult to look different, right? So on one hand, you have to be $1, and if you're not going to be pegged to $1, then like your stablecoin business is going to be over pretty quickly. The second one's liquidity, which is almost impossible for like a startup to come in and be more liquid than something that's at $140 billion in size. And then the third axis is return. And that's kind of like the insight that Ethena had, which is you don't actually have a different way to compete with these people unless you find a differentiated source of like alpha within the backing that you can sort of like use as a wedge to grow in the beginning, because you know that people within crypto respond to incentives and they respond to yield and that kind of stuff. The reason I'm giving that context is that I think another behavior that we've seen within crypto is that actually people want to live on one end of the extreme and like the middles actually die and there's really no interest for the middle. And what I'm referring to here is that you either want the most liquid instrument to trade in and out of, like a USDT, and something that is like safe and lindy through multiple cycles, or you want the thing with the maximum yield, which you can go and do a bunch of like different things with, like Josh was describing, building new infrastructure around it, new applications, and all those different pieces. I think this like slightly awkward middle ground of like T-bill backed assets, it's kind of like, it's not interesting enough at 4% to get people excited, because if you're, you know, speaking to a fund like Josh's, he can go do the cash and carry every day. And if he's not beating 4%, there's a bit of an issue. And so I think from our perspective, you have to kind of choose which end of the spectrum are you going to like optimize for and make sure that you're the best. And I think these sort of T-bill backed offerings are kind of like stuck in no man's land, where they're neither the highest yield as like a savings account, and they're definitely not the most liquid, like Tether on the other side. And so that's kind of the slight awkwardness with them. Yeah.
Yeah. Interesting stuff. Well, it sounds great. And it's obviously it's huge for Deribit as they continue their product growth to be, you know, bringing on these different forms of collateral and add them to the cross collateral pool. Josh, before we go, I can obviously, it's been interesting markets to say the least. For a few weeks, just I thought it'd be good to quickly get your sort of views on the market here. What's interesting you? Have we bottomed? What are the trades that you like right now?
Yeah. I think just looking back the last couple of days, right, there's been these sort of almost like short squeezes type of events across these, you know, smaller cap tokens, like newly listed tokens, things like that. I kind of see it as a little bit of a rotation right now from like high quality names like Bitcoin, ETH, Sol, right, majors, into like some of the stuff that had been shorted in some format, right? Like people probably like selling into listings via derivatives and things like that. Also, people sort of running like long short books where they have long major short alts. That's been like a very popular trade. So we're kind of seeing this reflected in some ways, right? So the biggest way is obviously like the funding rates on Bitcoin and ETH. If you look at the front of the curve, pretty negative right now. So you can kind of maybe think of that as like some rotation happening where people are selling majors to buy back some of these like shorts. That's kind of our view. It's it's a weird phenomenon, because normally, right, like in this type of market where there's not massive liquidations, you would expect those funding rates to be like flat to slightly positive. But I mean, look, the great thing about, you know, going back to USDE is there's like the flexibility, obviously, to hold like positively yielding T-bill exposure instead of like putting it on the negative, you know, negatively yielding basis trade right now.
Yeah, it's a nice offset for sure. All right, guys. Well, listen, thanks very much. Great to have you on, and Guy, great to meet you. And congrats on everything. I mean, it's a phenomenal success already, and the growth and the outlook looks phenomenal. So thanks, guys, and we'll speak to you soon, no doubt.
Awesome. Thanks for having us.
Thank you.
Thank you, guys.
So there you go. Remember, guys, like and subscribe, and we can keep getting guests like this on, like the Ethena guys, like Greg here. Greg, what do you think of that?
Fantastic. Yeah. I think one of the things that's very interesting, so a yield-bearing Ethereum token as collateral, theoretically, I could short the future against it or do some covered call strategies against that and sort of make money on both sides.
Yeah, I mean, I think this whole yield-bearing collateral ideas, you know, again for traders, right, it's going to be really interesting in terms of the opportunity it throws up. But again, we can have a whole conversation on that.
Sure.
But listen, Greg, thanks so much for coming on. I think before we go, like, what would be the one or two things that you'd want to leave people with today?
Yeah, absolutely. I think one of the main things to keep in mind is that even if you're a short-term trader, view your career on a long-term basis. Just like David was saying, you know, over the long-term horizon, markets go up. You want to make your money slowly in a scalable way through correct decisions of compounding good decisions throughout your trading career. The problem with trying to make it all at once, you know, 10x your account in 6 months, you're just going to lose it. That that is not sustainable, and it doesn't work in the long term. So trading is really about a million good decisions over a career as opposed to a couple get lucky decisions.
Yeah, and that's good advice. And it's funny because I sometimes get people kind of say I'm a permable and stuff, and which I'm not. We're for me, we're still in this bullish environment aside from what Trump's doing with tariffs. But I think for me, and particularly in terms of my view and thesis around Bitcoin, is that I want people to capture the longer term trend on this. And a lot of what I try and say around times like this, where with peak uncertainty, peak volatility and risk, is to kind of just zoom out a little bit and don't lose your shirt. And don't stop yourselves out when and miss kind of the bigger trends. So I think that's sound advice. Compound over time, and we should all do pretty well.
Thanks so much,
Greg. Thanks so much. Thank you.